So what we're going to talk about today is the 62 plus HECM loan. And the reason why I'm hosting this, or we're hosting this webinar, is because a lot of people, are limited on the cash purchase and the amount of cash they have in order to, get their dream home and the home that they want. And so a lot of my clients have utilized, and our clients, Stacy's helped a lot of my clients utilize this tool to be able to double or even triple their purchasing power so they can actually get into the neighborhood and get into the dream home they want. So Stacy, I'm going to let you take it over from here, and you want to introduce yourself, and then we'll get into the questions.
Hi everyone, thanks for joining us today. My name is Stacy Hunjady with Arbor Financial Group, and a reverse mortgage is a great product, but I also do forward mortgages, and I've been in the business 31 years. And as Jocelyn said, we've been working together for about 10 years, and I couldn't ask for a more amazing realtor to work with as Jocelyn, because she really goes above and beyond for her clients. So I'm grateful to work with you and the client we work with together.
Yeah, I think let's just go ahead and start with, I guess, just give me a little bit of a history on the key time periods with the reverse mortgage and when it started. And what I want to talk about is the 62 plus HECM loan. I guess let's clarify that it is a type of reverse mortgage, but it is a safer reverse mortgage because, a lot of my clients are really worried about this type of mortgage because of everything that happened in the past. So let's touch on that briefly.
Sure, you got it. So the very first reverse mortgage that was done was in 1961, which is 62 years ago. So while it's been around, for quite a while, there have been a lot of enhancements that have happened since then. The first reverse that was insured by FHA didn't happen until 1989. So there was a lot of time that went by from 1961 to 1989 where, all the regulations weren't formed. So, they were kind of learning as they went, so to speak. In 1987, counseling was required for anyone getting a reverse mortgage. So what that means is there is a third party that is trained and approved by HUD that does counseling for anyone obtaining a reverse mortgage. So a client cannot get a reverse mortgage unless they get that counseling. And what it does, it goes through all the options that are available to them for reverse mortgage. They also are really looking for, is the client who's applying, might there be any type of elder abuse going on financially? Like, are they being coerced into doing this? Are they of sound mind? Things of that nature, to really make sure that they understand, number one, what the product is, and that they're protected and that there's nothing behind the scenes going on, maybe from an in-home caregiver trying to force them to do something, or family member, and things of that nature. And then in 2008, the reverse for purchase was introduced. So previously, it was only refinances prior to 2008. And to this day, from 2008 until today, so many people don't know that you can purchase a home with a reverse mortgage. So it's always surprising to me that people don't know that. But what that means is we are not doing a good enough job letting the consumers know that it is an available option for them.
Just real quick, I actually had a client yesterday say the same thing. She said, wow, I had no idea you could actually use it for a purchase. I thought it was just for a refinance on my current home. And I said, no. So that's an interesting thing you talk about right there.
Yeah, definitely. And again, it just tells me we need to spread more information out there, in the community. And not every lender does reverse mortgages. It's a specialty type of product, so not everyone offers them, and then not everybody is trained in them. So it does make a difference. There's a lot fewer people who will do reverse mortgages. And the big, I'll say, elephant in the room, and what happened and changed in 2014 was the non-borrowing spouse protection. So a lot of questions I get are, can I be foreclosed on? And, I heard that people, like a widow or widower, would get kicked out of the house and they were foreclosed on with a reverse mortgage. Well, in 2014, the non-borrowing spouse protection came into play. So what that means is, if a spouse is not on the loan, they're considered non-borrowing. And after 2014, if the spouse that's on the loan passes away, that non-borrowing spouse can still live in the home as long as they are alive. And as long as they're paying the property taxes, paying the insurance, homeowners association dues, and maintaining the property, they can live there. Prior to 2014, that wasn't the case. And so unfortunately, we learn things when things happen, right? We learn by history and looking back. So prior to that, what was happening is, for example, let's say I'm 75 years old and my spouse was 60, and this is prior to 2014, my spouse could not have been on the reverse mortgage. So I'm on the reverse mortgage, I pass away, my spouse is still alive, and they would have had to refinance the house. Well, sometimes they couldn't qualify, many times, or they would have had to sell.
Mhm.
So some would get foreclosed on. And so those safety guards were put into place in 2014. So that's a huge change and a huge protection for the families who are entering into reverse mortgages.
What people were afraid of is that the houses were getting foreclosed on because of this reason. This was one of the number one reasons why they were getting foreclosed on.
Yes, is a spouse being in there and then they weren't technically on the loan, so they weren't on title to the mortgage. So now a non-borrowing spouse, they will be on title to the home. They will not have, for example, we'll get into this in a little bit about the line of credit with the
Mhm.
HECM loans. They don't have access to those funds if funds are available, but they can live there again as long as they're alive. So that was the biggest component.
All
one
right.
one of the things I'll quickly jump to is, one of the myths is, can it be foreclosed on? The answer is yes, if you don't pay your property taxes, home insurance, HOA dues, again, if there are any, and if you don't maintain the home, meaning like if the house is falling down and all of a sudden there's a huge insurance claim and you can't get a hold of the clients and they're just not returning calls. I mean, that would be an issue where the lender would come and say, hey, what's going on here? And you do have to write a statement each year that you are alive and living in the property.
Mhm.
So they make sure that it is owner occupied. But if you don't pay your bills pertaining to the house, you will get foreclosed on, just like a regular mortgage. And even if the home was owned free and clear and you didn't pay your property taxes, eventually you would get foreclosed on. So
Right.
it's no different.
Yeah, absolutely. Well, that makes a lot of sense. Well, thank you for that. The next question is, why is there an insurance fund and what does it do?
Sure. So there's an insurance fund for the HECM loans for protection. And so in 1987, the Housing Act required that the loan provided a guarantee to the borrowers that they would be protected against disappearance of their lender and obligations beyond the value of the home. And it was secured by the general insurance fund. So there is mortgage insurance that is paid upfront one time at the initial closing at part of the closing costs. And then there's an annual insurance premium. And that's even the same on forward FHA mortgages. So since this is an FHA insured loan, this fund protects the borrowers. And it also makes it what's called a non-recourse loan. So that means that the house is the collateral if anything should happen. They're not going to try and go after any borrower's assets. You can never owe more than the home is worth. So that's what the insurance fund does, where it's self-sustaining if something should happen.
Got it. Okay. Well, that's interesting. So do you have an idea, like a rough idea on what the costs are for that, like when you close and what they are annually?
Yeah, so with the annual mortgage insurance premium, it is 0.5% of the amount. And so that's annually every year.
Mhm.
And then upfront, it's 1.75. And so that amount is part of the closing cost that on a refinance, it's part of the loan amount, and then it's financed in on a purchase. So it'll balance out with the initial closing.
Okay, perfect. Okay, great. And so I guess the next thing that we'll lead into is, are there safeguards with this, type of loan?
Yeah, so with it being non-recourse, and again, non-recourse being that the house is the collateral should something happen, and then the mortgage insurance premiums that we just discussed are on top of it. So for example, let's say somebody has been in their home and had a reverse mortgage since they were 62 years old. Let's say the market did what it did in 2008. and the values are down, but this, the loan balance is up. So at this time, if the client owes more than the home is worth and they pass away and the house is given to the heirs, then the mortgage insurance premium covers that shortfall between what the house is valued at and then the outstanding balance. So that's what it also means by no recourse. And that is one huge safeguard. The
And that
next
wasn't
safeguard,
like in '08, they didn't have that safeguard. So mortgage insurance wasn't required at that time.
well, for mortgage insurance, they did have, that was in 1989.
Okay.
They insured, yes. So it was
Okay.
going since 1989.
Oh, got it. Okay. Got it. Okay.
Yeah. And financial assessment is the next one. So that came into play where they are looking at a client's monthly obligations. They look at how much debt they are carrying to make sure that they have enough to pay taxes, insurance, HOA, and their monthly obligations. And then they look at the credit history, but not credit score. So the two biggest key components are if somebody has made on-time mortgage payments for 2 years and property taxes and insurance on time for 2 years. If not, they're not going to be declined for a reverse mortgage, but they might have what's called a life expectancy set aside. And the short acronym is LESA, LESA. And they would set a chunk aside for the property taxes, insurance to be paid, with the loan over X amount of years. And that's again, if someone was late on that. So they do look at the financial overview of a client to make sure that they qualify, so to speak, but there's no mortgage payment. So it's much easier to qualify.
And real quick, like with that, what if somebody was renting and they don't have like a few years of, proof of on-time mortgage payments?
Great question. So then they're going to look at the rental history. Do they have 2 years of on-time rental payments?
Oh, okay. Got it. Perfect.
And then if there's no rental payments because they're living rent-free, like let's say somebody happened to be living with a family member for the past 2 years, then they're going to look at overall, what is the credit history? Do they have on-time payments? And do they have anything like car insurance that we could look at for the past 2 years, alternative things like that.
Okay, perfect. Great.
And then non-borrowing spouse, we talked about, do you feel that, that is a safeguard, that protection that went into place 2014. Do you have any other questions on that you think I haven't elaborated on?
I think that's it. We talked a little bit about the counseling and how important that is. And that is the biggest safeguard I think that has come into play recently, and touch a little bit more on that, I think that in '08, they didn't have counseling. And that's what got a lot of people into trouble because a lot of people didn't even really know what they were getting into, right?
Yeah, the counseling has changed a lot over the years. So it started in 1987, but at that time it wasn't regulated where the counselors were trained, so to speak. It
Mhm.
wasn't the HUD requirements. So that wasn't until the recent years. And once they do counseling, and for example, I've had clients ask me, can I attend the counseling? I cannot.
Mhm.
A family can attend. They encourage family members to also attend the counseling. It's on the phone. I don't know if there are places that still do it in person. There might be some, but I think they're far and few between. So it's mostly on the phone. It is a fee of about $150 to $200 upfront with a credit card. And they go over everything. And once that counseling is done, they get a certificate. And then they cannot do anything with the reverse mortgage. They can't complete the application, order an appraisal. They can't do anything for 7 days in California. It's a cooling off period. So what that is it just gives them time to think more about it, do more research, get any other questions answered that maybe the counselor brought up that wasn't covered or addressed by the lender.
Nice. Okay. That sounds great. All right, well, let's move on to just a few, I guess, misconceptions, myths, facts. There's so much bouncing around out there about the HECM loan, the reverse mortgages. And again, like I said earlier, so many people are so afraid of this type of loan, but I think it is such a unique, really amazing tool to be utilized. And I think that it's something that people should know more about. So kind of tell us a little bit more about that.
Sure. One of the questions I get frequently is, well, I don't own my home, the bank does. And that's a myth. you own your home just like you do if you got a forward mortgage or if you had no mortgage. Obviously, if there's any type of mortgage on the property, then there is a deed recorded. And so same thing with a reverse mortgage, and you own it. You can sell it. You're not stuck in that home forever. Some people also think a myth is that, oh, once I'm in the house with a reverse mortgage, I'm stuck there. I can't ever do anything with it again, which that's also a myth. You wouldn't want to get a reverse mortgage today and then say, oh, I know I'm going to move in 1 or 2 years. Financially, it wouldn't be worth it because you have the upfront mortgage insurance costs and things of that nature. So you definitely would want to at least be there for a little while. And we assess that to look if it would or would not be advantageous, because we want to make sure that the clients get the best, for what their goals are.
Mhm.
Another one is they want their heirs, whether it be kids or grandchildren or whoever in the family, to get the home. And they still can get the home. And they think that sometimes the heirs will inherit any outstanding mortgage debt. And so that's not the case. Like if you had a regular mortgage today and passed away and your kids got the house, then that mortgage still has to be handled. It has to be refinanced and paid off, or maybe the kids are going to sell the home. Same with a reverse mortgage. So the heirs will still inherit it. And again, if we're in a market that was crazy like 2008, which hopefully we'll never see again, but if we were, again, that mortgage insurance fund is going to cover the variance of, the deficit of the equity.
Got it. And so, I mean, the biggest thing, and I guess the biggest confusion with that is, with a regular mortgage, you have a loan on the home and you have the principal and interest payments that you make. And it's the same thing with the reverse mortgage. It's just that the principal and interest payments are being held against the equity of the home. And then you're going to pay that off just like your regular loan when you sell the home, or if somebody passes on or whatever. It's the exact same thing. It's just that it's a program to be utilized for people that want to preserve cash because they're retired, right? Is that kind of what I'm gathering?
Correct. And
Yeah.
so with that, the equity is in essence paying for the payment, so to speak. It is being held, like you said. I like that term, how you phrase that. And at such time when it's paid off, that's when everything gets paid off. So then you also will get your interest statement. So if you sell your house and you have a reverse mortgage and you hadn't made any payments, that's when all the interest, if you will, for you to report on your taxes. I just had a client actually who had sold their home, moved out of state, and they're like, oh my gosh, we got $8,000 back on our taxes because the reverse mortgage we paid off. And they weren't
Oh, wow.
expecting that. So that was a benefit. Now, if the heirs inherit the home, there is a one time, and this is verified with the CPAs and financial planners, but they will get the benefit of that interest one time that had accrued over the life if the borrower passes away and then the home transfers to the heirs. So there are many good benefits. I know I'm kind of jumping between myths and benefits,
Yeah.
back and forth, but one of the things that's a myth, as far as still staying on the heirs, when an heir inherits the home, they will have up to 6 months with 2 90-day extensions to decide if they want to sell it, or they can do a deed in lieu of foreclosure. Some people choose to do that method, or they can satisfy the outstanding balance if they wanted to, remain, like live in the home. And again, that balance, they wouldn't owe more than the home is worth, or they can also purchase the home for up to 95% of the appraised value. So I had a situation where one of the heirs bought the property at 95% of the appraised value, which was a discount, versus paying off what was owed on the loan. That's the route they decided to go. So there are definitely options.
Thanks.
And again, a lot of good options for the heirs. Another myth is I can be foreclosed on anytime. I think we've touched on that one a lot, but I just want to reiterate, FHA guarantees this loan that you can stay in the home as long as you're living in it. It has to be your primary home, and that you maintain your property payments, taxes, insurance, HOA. And this is a big one. Reverse mortgage is a loan of last resort. And so that used to be, and still is in a lot of people's minds, that it's only for people who are desperate and people on hard times. And that's what it was initially marketed as and what it did. And it just is one of those loans that's not the case. It's the new reverse mortgage, if you will. So I have had situations where people wait. They're like, I don't want to do it now. I'll just get it when I need it. And I can think of two recent situations that one client, husband passed away, and they did need more income, unfortunately. And so she was struggling and having a very tough time. And at that point anymore, she couldn't get a reverse mortgage. And so she had to end up selling her property and, going through the process of all the other stuff. And had they gotten the line of credit when we talked about it, she would have been in, and she could have also gotten additional monthly income from the line of credit. So that's one situation when people want to wait. Waiting doesn't work in your favor. I'm going to jump to one benefit real quickly, is the line of credit that is available with the reverse mortgage. That's going to be based on age. If you had a mortgage on the property, or if you're buying it as a purchase, the line of credit that is not used, that will grow by what your interest rate is per year. So what that means is, for example, if you have $100,000, next year it might be $108,000, depending on the interest rate. So the unused portion each year will go up, and that's available. So again, had they gotten that when we spoke at 63 years old, it would have grown when he passed away, at 68 years old, and it would have been a huge benefit. So
real quick, I have a question on that. So the line of credit is, so you have the loan and then you have the equity. So the line of credit comes out of the equity if you were going to need some extra money to make payments or do a fix on the house or something like that. Can you just dive a little bit more and explain that, what that line of credit means?
Sure. So for example, there's a principal limit factor that FHA has. It's $1,089,000 and change. And so that's what they look at for, I'm going to say, the value. If somebody purchases lower than that, then it's the value is the max amount, if you will, and then their age. So those components play into how much is available on a line of credit. So some people want to put, I'm going to say, the minimum down for a reverse. And if they do that, they don't have a line of credit available.
Okay.
I had somebody who came to me and they go, I want to put 500,000 down. Well, because they put so much more than they needed to down, their line of credit started at, it was like 280 some thousand. So that 280 some thousand is available to them to draw on. And, they call and say, I want X amount. They get the money in 24, 48 hours. And so they could pay it back if they want, and the money is available again, but they're not required to pay it back. So it just depends on how much money, what the loan, I'm going to call it a loan to value factor. In the reverse world, it's not called that, but how much they have available. And again, that's primarily based on the age and the value of the home.
Oh, interesting. And so that line of credit is accruing interest over the years if it's not used. So it's actually kind of a nice little investment tool as well. I didn't really know anything about that. That's really a neat tool.
Yeah, the growth factor, it's called the growth rate. And what happens also with it is, I keep referencing 2008 because that was such a pivotal point. But if this happened to anyone on this call, or if somebody knows somebody it happened to, you had credit card companies that were reducing people's available credit card balance because people weren't paying and everything was crashing. You also had banks with equity line of credit saying, oh, you no longer get to use your line of credit, or you had 200,000 available, we're slashing it to 50,000, or we're just closing it out. That cannot happen with the HECM. You have that line of credit, your unused portion, it will grow no matter what. Even if you're 100 years old and haven't used it, it's still growing. So
Wow.
they can't take it away, they can't change it. And some people utilize it, which I'll do this at the end. It's called sequence of returns, where they draw from their line of credit and then they make a payment back, when the market's better. So then they have it available again. So it's kind of you can do a give and take with it, but again, payments are not required.
Wow, that's interesting. And I love the fact that, like you said, when things are tight in the economy and, you know, the credit cards are being withdrawn, the equity lines are being withdrawn, this is something that cannot be withdrawn. And I think that is a huge benefit for people that I really personally didn't, I guess, probably understand about this. And now it's 100% clear. I think it's really a neat tool for sure.
It really is. And that's where, kind of drifting from a loan of last resort to the new reverse mortgage and really using it as a retirement planning tool has been huge for people.
Yeah, that's a good way to look at it for sure.
Yeah.
Perfect. Well, yeah, let's move on to some more benefits because I like the benefits of this this loan for my clients.
Yeah. Um, so one benefit we've talked about, that there's no mortgage payment required. Again, people can make a mortgage payment if you choose to at any time. And that would be, again, a conversation with CPA or financial planner to see, would it behoove you to offset any, potential taxable event you may or may not have.
Mhm.
We talked about, which again, I think is my favorite and one of the best features, the unused portion of the line of credit grows each year. You can get monthly income from your line of credit that's available. So you could say, oh, I want to get $1,000 a month over the next 12 months, or I want to get $1,000 for life if the math works out, of course. And it's not taxable because it's not technically income because it's equity from your home. So you're not taxed on it. You're just
Wow,
utilizing the equity from your home.
that's
I think that's
amazing.
a huge
And
one.
didn't you say that one time you actually were able to qualify somebody? They were a little short on income, so you were able to set that program up where they were able to get that income going forward, and that helped them qualify what they needed.
Yes.
That's
Yep.
pretty unique. That's a neat way to look at it as well.
Yeah, it definitely was great because it made a difference for her. She had lost her husband and she was just short, and she needed a new roof on the house, some other repairs. And so it was one of those things that it all came together very nicely for her to have, a chunk in the bank as a nest egg, and then plus the monthly tenure that would come to her.
Wow, that's awesome.
Um, One of the other benefits is use this as a wealth multiplier to pass on a larger nest egg to the next generation. So I always hear, I want to leave the house to my heirs, and it's less than 5% of the heirs move into the home that they're left. Most of them sell it.
Right.
That's such a small amount. And I think people are living longer, and, we've heard like 60 is the new 40, 40 is the new 20, all those things, which I think is true. And with all the medical advancements and living longer, why not do things now while you're living with people? And yes, you can leave a nest egg and leave your generational wealth, but the reverse mortgage can help you do that on a larger scale.
And then one thing, and I want to touch on that because I love that so much, is a lot of people say that to me too. I want to leave my home to my kids. But what I always tell people is, you worked hard for your money. So why not buy a home that you can actually enjoy and that you love living in and, in your retirement years, because you did work hard for your money and you should be able to use that. And at the end of the day, you still have a house. You're still probably going to have some equity that you can leave to your children or your family members. But at least you get to enjoy the retirement years in your dream home.
Right, exactly. And same with me with the clients that I speak with is you leave it, but none of us can take our money with us when we pass. And it's like, do things in the here and now, and you can still leave something. But again, with less than 5% moving into the house, I hear so many kids say, I don't care about getting the house. I want to be with my mom and dad. I don't
Mhm.
care about the furniture. And, it's like certain, depending on certain generations, what age they're at. I hear from a lot of the clients that I have this big, beautiful wood furniture and my kids don't care about it. They don't want it. I have these antiques. So kind of same, with the houses, people are living longer. I had a client who was 92 and the child was like 70. Well, at 70 years old, is that adult child going to move into mom and dad's home when it's across the country? They're probably not going to uproot their life at 70 years old and, move from New York to Rancho Bernardo back in their parents' home. So I think that there's a lot of that thinking that, is just different depending on when we all grew up.
Yeah, and to touch on it too a little bit, the monthly mortgage payments that somebody's going to save, from their regular income, you can go on a trip, you can go take your family and enjoy, each other's company. And that's what I try to, I also tell my dad the same thing, because he's always like, well, we got to preserve this. I got to do this. I said, no, enjoy it. You've earned your money. Let's go on a vacation and let's enjoy each other, while we have the time. So.
Right. It's the memories. It's, sharing with your children and if there's grandchildren and, other family members. And it's special because, again, we can't get time back.
Exactly. Perfect. Well, we have a few more minutes, so let's touch on some more benefits and then we can go into any questions and answers that anybody has.
Sure. And another one is you can use this to assist with tax management to possibly get deductions when needed or withdraw less from your, taxable type entities. So IRA, or if you're at the mandatory distribution age, things like that, taxable events. But that is something definitely to consult with a CPA or financial advisor. Another big one is helping with healthcare needs. So I have a lot of clients who are like, I want to age in place. I want to be in my home. I never want to go to a nursing home, but how do I get the care I need? Because either my family isn't able to care for me, possibly because either they don't have the skill to, if it's, advanced health issues, or they work and they have kids. So sometimes it's not possible. So in-home health care, health insurance costs, things of that nature. So that's a huge one because, as we know, it's not cheap.
Yeah. And that is utilized through the line of credit, right?
Correct.
Okay. Got it. Okay.
Yep. And or if you think about it, not having a mortgage payment, people are building continuing to grow their other nest eggs by saving that money in other vehicles, whether it's a savings account, other financial accounts as well. Some people use it to purchase another property, such as a vacation home or a rental property. So obviously with a rental property, getting other supplemental income from that standpoint. It's helped
so let's
people.
touch on that for a minute.
Sure.
So you have the reverse, you have like the HECM loan, you have your primary residence. And so you're saying that people can use, the money that they would normally pay for a monthly mortgage payment to buy maybe a smaller vacation home or something like that.
Yeah. So for example, if I had a person who it was like a little over 500,000 on their line of credit, they withdrew that and then they paid cash for a property, like a little vacation place in Florida.
Oh, nice.
So
okay.
yeah, then their line of credit was used up, but then they had their primary home that they live in with no mortgage payment. And then now the rental that they paid cash for, no mortgage payment. And then they got the rental income from that.
Wow. That's pretty cool. That's great.
Yeah. Another big one, upsize, I don't see as much, but you can use it to upsize on a, larger home or a higher priced home that maybe they couldn't otherwise afford, and or downsize. Some people want to go from a 2-story to a single story, less bedrooms, or some people want to go from a single family home possibly to a condo because they don't want to maintain the yard and things like that. Condos are acceptable properties, but they do have to be FHA approved on the HECM. Okay. So yeah, that's just something, I can look up with the name, and it's something we could look at getting a whole project approved. The spot approval, which means one unit only. They don't do that for the HECM. The reverse mortgages haven't caught up to what the forward mortgages do with that. And then the other, it helps bridge a gap from the Medicare gap from, 62 to 65 years old. So those are the biggest benefits that I see and like to share.
Nice. I love that. Well, I feel like there's so many more pros and benefits than there are cons and negatives. And I really think that it's pretty amazing for people to be able to get this information and hopefully, want to learn more. And then, oh, actually there is one question. So what is how do you qualify as far as the down payment requirements? Because I know sometimes there's a 50% and 60%. So how do you know what amount of cash you need at minimum to put down?
So what I do is there's like, we plug it in the system, honestly, because it has to do with three factors: what the value is of the home, the age of the youngest borrower, if there's more than one borrower, and then it's called a swap rate. And that's basically what FHA uses as the benchmark. So it's going to depend on where that interest rate is as well. So on a forward mortgage, I could tell someone today, oh, FHA is 3.5% down minimum,
Yeah.
but it's not that easy with reverse. So it would be either, a quick text, phone call, email to me just saying, here's my age, here's the value of the home. And then I would plug it in and then say, here is what you would need total for down payment and closing costs. And then I would say that gives you X amount of line of credit, or if you just put this amount down, you have no line of credit. So I give the options to let people know if their goal is to have a line of credit.
Perfect. That's great. Well, thank you so much. And what's so interesting, and I just want to touch on briefly, is a lot of the clients, the people that I've spoke with, they're moving from the Midwest. They want to get into the perfect weather, which we do have in San Diego, even though it rained a lot recently, but I still call it the perfect weather. A lot of people are selling their homes for, $300,000 or $400,000. And, in San Diego, to buy something for $300,000 to $400,000, you can't get a whole lot. And so this is why I think it's so important for people to learn more about this, because if, for example, somebody had $300,000 or $400,000 cash, they could potentially buy a $600,000 or $800,000 property, which will get you into a really nice neighborhood in one of the 55 and up communities that I work in, and even, a small condo, or there's just some really nice options when you get into that price point. And this is just such a great tool to be able to do that. So thank you so much, Stacy, for being here. I really appreciate it. And
thank you for having me.
Yeah, you're the best. And everybody here, if you want more information, you know how to reach me. Please email me. And you have my cell phone number as well. I'll give it to you here. It's 858-349-9663. You can check out my website at jocelynrealestateteam.com. And we look forward to hearing from you. Thanks for being here.
Thank you.
Okay, bye-bye.
Bye.